Hey cats, it's Rich. Happy Monday. Okay, I'm recording this on Friday again. We want to talk about what is going on in the economy. The big thing, we've been talking about it a little bit, is the war with Iran and moreover, the Strait of Hormuz. The Strait of Hormuz is a huge choking point in the Persian Gulf where oil is going from the Persian Gulf out into the Indian Ocean. Why is this such a big deal? Over 20% of the world's oil comes through there. China is one of the biggest buyers, especially of Iranian oil. And what we've seen is Iran is not letting any ships through. Because they're not letting any of these ships through, oil prices have skyrocketed. WTI has gone up over 50% since mid-February levels. Well, okay, aside from the effect in your gas tank, what else is that doing? Well, when you buy stuff at the store, it had to be trucked there. You had to use energy to produce it. You had to use energy or chemicals for the raw materials. So we're going to see inflation increasing. And we're going to start seeing these readings in the next month or two. And when we start seeing these readings, it's going to make the Fed even more reluctant to cut interest rates. As we talked about before, the European Central Bank has already threatened up to 3 rate hikes this year due to the inflationary pressures. Okay, does that worry me? A little bit, yeah. Whenever things are more expensive and people already don't have enough money, they're going to be stretched thin. That's going to make it even more difficult for people to live their everyday lives. So let's talk a little bit more about this. What is the effect of the inflation? Well, the consumer price index and producer price index, they're a 12-month trailing average. So if the numbers we start getting in April or May are significantly higher inflation numbers than we've been receiving, what's going to happen is we're going to have those effects for 12 months. And even though inflation may start coming down, the trailing 12-month index is going to be keeping the inflation rate higher, which is just going to prevent the Fed or stop the Fed from wanting to decrease interest rates. Now, in May, Jerome Powell is no longer going to be the governor. President Trump gets to appoint another governor. We'll see what's going to happen. Word is he's going to be a heck of a lot more hawkish against the inflation, and he'll be more likely, more apt to cut interest rates. What else is going on? Initial jobless claims. This is people who are filing for unemployment for the first time. It rose 5,000 to 210,000. It's still a low figure because, once again, people entering the gig economy are not reflected there. ADP Employment has released their report. It shows that private employers added an average of 10,000 jobs per week in the last 4 weeks ending March 7th. However, the last Bureau of Labor Statistics reports showed 92,000 job losses. And here's the thing, guys. Remember, the Bureau of Labor Statistics report is always optimistic. Whenever they start taking retroactive looks at that report, we notice that the job losses are never as good as they told us. This means that there are probably even more job losses. So net, there are less jobs out there right now. And so what's going on in the Houston markets? Houston markets are doing pretty well. February to February, the sales declined 3.3%. Units. Dollar volume was only down 1.7%. That means that property is not getting less costly. We're not seeing that property values are going down. In fact, Ted C. Jones, the chief economist of HAR, said, and I quote, "If you're waiting for the Houston housing market to bottom, it already did several years ago, and it's back to normal levels." So where are we seeing softness? Essentially, almost all of the segments of the Houston housing market are seeing increased volume, aside from 250,000 to $500,000. That's down 9.9%. And $500,000 up to $1 million, well, that's statistically flat. So what you're seeing is you're seeing a lot of investor activity, and you're seeing a lot of activity from the wealthy folks, the folks who can afford over a $500,000 property. So if you're in that middle section, the 250 to 500, what that means is you probably have a little bit more negotiating power right now, because that is the slow part of the market. Now, rodeo is finally over. I hope you guys went. I hope you had a good time. If you were on the dirt, I hope you had tickets or at least a wristband for it because you didn't want to get dragged out. But one of the great things about rodeo being over is now we're getting back to business. I've been tracking numbers since 2016, and I found that the volume of new inquiries that we receive during rodeo is generally 90% lower than the rest of the year. So when we see that adjustment for 90% down, we're going to see a little bit more slowness coming next month due to the rodeo effect. However, we got a lot of folks who are still interested. Even with our rising interest rate environments, interest rates are still well below 51-year average levels. And with the lower property taxes that the Texas government has given us, property is still more affordable. So my recommendation is this: if you're outgrowing your apartment, if you've outgrown your house, or your house has outgrown you, and you need to move, don't be waiting for lower rates. Take advantage of this opportunity right now where that $250,000 to $1 million, there's a lot more negotiating room. If you got any questions, give me a ring. This is Rich with Homebuyers Home Loans, 281-841-1723. Have a great week.